We've flagged how economic rules could bind policy. This played out quickly last week, with the US softening its trade stance on China. Decoupling from China, bringing production closer to the US, and supply chain diversification are top US strategic priorities. Yet such goals must confront a core economic rule. Global supply chains can't be rewired quickly without major disruption. Tariffs can raise costs, cut access to key inputs, and potentially halt production. China is a key supplier of critical minerals, semiconductors, industrial parts, specialty chemicals, and auto components. The binding effect of economic rules on trade policy means it will take time to rewire trade relationships and see the damage from tariffs. So far, analysts have sharply cut estimates for 2025 earnings growth for the consumer discretionary and industrial sectors due to their reliance on foreign revenues and global supply chains. We look for signs of pressure in corporate commentary on supply chain disruptions, changes in the ability to pass costs to consumers, and shifts in consumer demand. For the magnificent 7 big tech companies, we're eyeing changes to AI capital spending plans. Economic rules can bind policy quickly. That's why we see policy uncertainty easing over the next 6 to 12 months, keeping us overweight developed market stocks.